So today we're here to talk about tax pro formas. All right, let's make this a little bit more interesting. So you go to your CPA, it's April 15th, you haven't talked to him all year long, and you get a tax bill of $10,000 and you say, I really dislike this CPA. It also could be the other way where you get a tax refund of $10,000. Say, I love this person. In both of those situations, it sounds like no planning has been done. And if you know anything about myself, my partner, John, Michael Scott here in our office, we love to plan. It's what we do. And taxation for us is it's another kind of arm of financial planning. For each one of our clients, as part of an added value service to our firm, we provide a tax overview of where you land. Now, if you're a business owner watching this, you need to have a dedicated CPA because there's so many ins and outs. There's bookkeeping and all of these other portions. But a big chunk of our clients are really divided into two very distinct categories. We have our accumulators, and our accumulators are our clients that are still working, our pre-retirees. And most of the time, they're dealing with W-2s, right? They work a job, they have W-2s, they have interest, they have dividends. Maybe some of them are self-employed and have a Schedule C. So they have their 1099 employee and they have some income coming in from that source. So we have our accumulators that we're going to talk about here today. The second piece we have to talk about here today is our retirees. What's not fair is just to talk about one class and not the other, because really our business is made up of both of them. So there'll be two very distinct paths that we go down today. One will be talking to our accumulators, one will be talking to our retirees. And again, all of this is going to revolve around making sure that we don't get to April 15th and wonder, are we getting a refund or are we going to have to stroke a huge check and owe a bunch of money to the IRS? So again, this is done right here in-house at Candor Path. We have all of the tax software and all of the expertise and know-how to make sure we have a tax plan in place for you. What we want to do today is show you the process. Why do we ask you for this information? And maybe some of you watching this say, gosh, I had actually no idea that Candor Path offers this as a service. So we wanted to share with you what is the steps that go into and what is the behind the scenes on how we create a tax pro forma and why it's important.
Yeah, that was really great, Matt. I think first things first to get started is we need to understand what a tax pro forma is.
Awesome. So what is a tax pro forma? It's nothing more than figuring out what your income is going to be throughout the year. Now, most time we start a tax pro forma after tax season. For the two of us going through up to about 200 tax returns, by the time April comes and goes, the last thing we want to do is talk about tax. But right around June, we get a little bit of amnesia and we're like, hey, that wasn't so bad. Let's now start planning for the second half of the year. And so that's really where a tax pro forma comes in. It is truly nothing more than developing a plan of how much income you've had year to date and what that projected income is going to be for the rest of the year. And where do we think we're going to land on December 31st? All right. So again, tax pro forma, a forward-looking estimate of your tax. And why is this important? Well, because as life and careers happen, we've got to constantly make these changes. And the way that we calculate this is we look at your current income, we look at your current withholding, and we try to calculate what is that forward-looking number going to be at some point down the road. Okay, so why is this important? As I sort of talked about a moment ago, we want to avoid a tax surprise. Now, is this perfect? It certainly is not. There are so many pieces, and we're going to show you today why some of those pieces can be complex, but we want to avoid a tax surprise. We want to adjust your withholding with plenty amount of time if there's going to either be a large surplus or writing a large bill to the IRS. And we also want to educate our clients on what is an estimated tax payment. For those that don't know what an estimated tax payment, it's paying the IRS on their schedule. And they have this lovely schedule that makes very little sense. And they love to receive income from us U.S. tax citizens on April 15th, June 15th, September 15th, and January 15th of the following year. If you're not confused about that, it's okay. You should be, because first of all, none of those are equally spaced time periods. And the last one is actually due in the following year, which doesn't make a whole heck of a lot of sense. But that's how estimated tax payments work. And we work with our clients when we can't adjust withholding, we can't adjust IRA distribution withholding. We then go to our last resort, which is actually just stroking a check over to the IRS. So we're going to go through each one of those pieces here today. All right, so first up is for our accumulators. As I defined earlier in this presentation, those are our clients simply just working still. So if you are a retiree, you have permission right now to get up, go grab a cup of coffee. Don't go too far because in about 2 or 3 minutes, I'm going to come back here. I want you to come back here and I'm going to talk about what important elements are part of your tax pro forma. But for right now, we're talking about the accumulators. And so again, those for our clients who are currently working. And when I say working, they're most of the time paid, or at least reported their pay is on tax form W-2. So for our clients that are working, we want to see a copy of their latest pay stub so that we can try to calculate what their W-2 is going to be on December 31st. So for our clients working, it's either going to be a pay stub showing that information, or if our clients are self-employed, it's taking a look at how much taxable income has been accumulated so far this year and how much expenses have been accumulated so far this year, so we can try to calculate what taxable income looks like as of right now. So the first thing we want to do is analyze your pay stub. So first up, we're going to take a look at your year-to-date earnings. We want to take a look at your withholdings. We want to take a look at your deductions, which will offset that taxable income. And last but not least, and oftentimes the hardest part of this entire exercise, is determining your pay frequency. Now, that might sound like the easiest one of this entire list, but we have clients that work for hundreds of different companies, and each one of them has a different pay cycle. Some pay bi-monthly, some are bi-weekly, some are on a random schedule, and it's up to us to sort of figure out how many pay periods are left between now and the end of the year. So this is what it looks like when we get that pay stub from you. You'll notice on our screen here, we have our boxes. Our boxes are first up here is our gross earnings year to date. Now, we conducted this with a client in June of this year. So this is basically the first 6 months worth of income. So taking a look here at box number 1, again, employees' gross earnings. And we see if we move over to the right-hand side, year to date, as of June, this client has earned $98,237 of taxable income. So that's the first very important number on this field that we need to look at. The second number we need to look at that's still in the same area is how much is their normal paycheck each and every pay period. And you'll see that this client is receiving $3,475 each one of the pay periods. So these are the first two very important pieces of information when we get a pay stub from one of our clients. Number 2 is how much federal income tax has been withheld. And again, looking at two very important pieces here. The first is how much year to date has been withheld from the taxable income. And that amount is $12,770 year to date. And we see that each pay period, about $1,089 is withheld. So again, two very important numbers. Two numbers that are not so important on this screen: Social Security and Medicare wages. Not really important because those are calculated via a formula. And so those are fairly automated, and we really don't need to calculate that ahead of time. We're able to just look at the formula and see how much Social Security and Medicare need to be withheld, and is that the proper amount. Oftentimes that's done by the payroll provider, something we don't even have to worry about. Box number 3 here is our deductions. So if you participate in your company's 401k, you have health insurance, dental, vision, if those are pre-tax items, those get deducted from your taxable income. So what would not be fair to do is just take a look at your taxable income of year to date $98,000 and not take into account that you're participating in your 401k, which if you're in your traditional 401k, those dollars are going pre-tax. You are getting a deduction for them. If you are participating in your Roth 401k, those are using post-tax dollars, in which case they would not come up on the pre-tax screen. So again, just important for us to note what type of a retirement plan you're working through. The fourth area on this screen right here is your pay period. As I talked about, it's oftentimes the hardest part here is determining. Now, this client is getting paid weekly. So again, we need to calculate how many more pay periods are between now, which this pay stub was given to us for a pay period ending on 6/7, between 6/7/2025 and December 31st. How many more pay periods are going to be between now and the end of the year? Again, sounds like an easier exercise, but when we do hundreds of these, each one of these companies are just have their own methodology for it. And also there's extra months inside, extra weeks inside of certain months. And again, getting us all the way through December 31st oftentimes is the most difficult portion here. But again, this is how we take a look at a pay stub and how we analyze it to get our year-to-date information and begin the process of creating the pro forma. All right, so we got your pay stub. We entered your current income year-to-date, your current deductions year-to-date, your current withholding year-to-date. Next thing we have to do is say, okay, between now and the end of the year, how much more income is going to be coming in, how much more withholding is going to be coming in, and how much more pre-tax deductions will be coming. We enter all of that information into our tax software, and now we're able to kind of pop out, if nothing changes between now and December 31st, here's what the tax pro forma looks like. All right, so on our screen here, we have our lovely 1040 form, again, for the same client that provided us that pay stub a moment ago. We see here on box number 1A, our estimated taxable income, which is $204,738. And again, if you kind of just look at that logically, year to date, the client had about $98,000 of taxable income. We have those pre-tax deductions that we took from there, and that's what we calculated the taxable amount should be on box 1 of the 1040, approximately $204,000. Now from there, we still have some work to do. If they are clients of CandorPath and we have non-qualified investments, we need to take all of our taxable interest, all of our taxable dividends that we estimate through the year, and we're able to do that through our brokerage portal, be able to see what are the monthly dividends coming in, what's the monthly interest, and sort of extrapolate that out. And then we're able to take any additional income that might be coming in for that client. So this one is the spouse is actually taking Social Security. So even though they're accumulators, there's still some Social Security benefits coming in. So again, we're trying to get a total income number using the 1040 to aggregate all of this. Once we add up all of this information, all of the interest and dividends and additional income, the W-2 wages, this client has a total income estimated to be about $268,405. We then take our standard deduction or itemized, depending on the client situation. We'll look at last year's to see, did the client itemize? Are they in one of these states that have higher state taxes or some ability to take a further deduction? Or are we just going to itemize? So we take that there on line number 12. We deduct that number from our taxable income, and we come up, with our adjusted gross income or total income, and we come up with our taxable income for this client is $236,105. We then run to see how much tax is due on that amount, and that number comes up to $40,114. Second exercise here is to figure out our tax withholding. So again, year to date, we have a number, but we have to extrapolate that out through the rest of the year. And for this client, we estimate tax withholding to be about $38,000. So we have now at least something to discuss. The client is owing $40,000 to the IRS, but only withholding $38,000. We know there's going to be about a $2,000, thereabouts, $2,000 tax bill that's going to be due in April. And now my job and our job, myself and Mackenzie, is to talk to the client about that. How does that make them feel, first of all? Well, if the number's $2,000, maybe not the end of the world. But what if it was $20,000? Completely different story, right? We need to talk about increasing withholding, making estimated tax payments. If they're not maxing out their pre-tax deductions, maybe upping that 401k contribution. We have time now here in June to figure out a problem that's really not going to manifest itself until next April. We have a long time period to fix any problems. Same thing goes in the opposite direction. What if they're getting a $20,000 refund? Well, again, that might be a situation where we adjust the W-2 withholding, right? Let's take down our tax withholding because we're going to get a massive refund. I'd rather those dollars be in your pocket. Maybe it's to pay down debt. Maybe we are building a savings. Maybe we want to contribute more to your retirement accounts. And now we have the ability to do so without waiting until next April and giving the government what amounts to basically a tax-free loan of your dollars. So this is the part that becomes really important, allows us to talk to our clients about what options they have. Again, in this situation, it's about $2,000 difference. So I can make a couple of recommendations. A, we could pay the bill at the end, and there might be a small amount of interest due because the IRS does not like it when you owe them money. We could make an estimated payment. We can make, 2 or 3 estimated payments of $500 or $600 to try to bring that tax bill down on what we estimate that it's going to be. Or again, we can adjust W-2 withholdings and bring it up or down. Really hard to do that when it's a very small amount, but nonetheless, it still gives us plenty of time to fix a problem that might come down the road. All right, so a few other things to consider here for my accumulators. One, this is a snapshot in time as of, in this situation, June. Well, we have a whole nother 6-month period of time. So much could change. What if you have a change in employment? You decide to re-employ yourself at a new company, or they ask you to not come back to work one day, which does happen from time to time. We need to make those adjustments when those situations come up. So again, just keeping an open line of communication once this process is done. Also, and this is always really tricky for us, is what happens if there's a big bonus in October or November or December? We want to make sure that we account for that. And maybe you might have an idea of, well, hey, last year I got a bonus of this and it occurred in December. Let's maybe shoot for that same number again, and we can build some of those pieces in to this pro forma. And last but not least, is I have a number of clients that I'm looking on our list here today of all of our folks that are listening in on today's call, is that some of them do receive commission or nonlinear income, right? Month to month, their income changes. So again, we want to make sure, taking a look and see again where we're at year to date, where they expect things to be between now and the end of the year. And maybe sometimes we use last year's numbers to predict where things might land this year as well. So just some things to consider. All three of those are fine. You just got to communicate with us so that we know, because we won't see your W-2s, we won't see those pay stubs. You got to communicate with us when those changes occur in the second half of the year. All right, so if my retirees have gone out and grabbed a cup of coffee, hopefully they're back now. My accumulators, feel free to step out for just 2 or 3 minutes here. Again, I'm going to sum up, and there's a few pieces here at the end that I definitely want you to listen to. But now I'm talking to my retirees. And again, I'm looking at our list here of all of our attendees. I see some amazing retirees. And what's going to be really interesting is we'll talk about state tax here too. I see a few retirees that are outside the state of Florida, and we're going to talk to them as well here in a moment. But first up, for our retirees, it's not dramatically different. It's sort of the same piece, except you're not going to be fully employed. So you're probably not going to have a W-2 to go off of, but you have your own sources of income. So first up is for us to establish, what is your source of income? Is it a pension from your company? Which frankly, those are few and far between these days. So not a lot of you have pensions, but there are some there that have pensions, and that amount typically doesn't change year over year. Maybe there's a cost of living adjustment from there. So those might have pensions. Those that are living off of their Social Security or using Social Security to enhance their income. So Social Security is another big source of income. And maybe the third biggest source of income is your own investments. You've been saving in your 401k all these years. You've been saving in your non-qualified account. You've been doing a fantastic job building up that nest egg. Now it's time to live off of it. So for us, we need to first determine for our retirees, what is your source of income? Next up is from that source of income, how much taxes are being withheld currently? So again, if it's a pension, if it's Social Security, if it's your IRA distributions, how much is coming out of those accounts? And then we can begin the process of creating that pro forma. The most important one here, though, is Social Security, because that's taxed in sort of a funky way. So again, as I'm looking at our list here today of our current attendees, and again, those that might be listening to this on recording, is taking a look. Now, if you say, hey, listen, Matt, we haven't started getting Social Security yet, but this is the year that it starts. Well, the first thing that we would want to go to is your Social Security statement. And specifically right here is your personalized monthly retirement benefit, right there, that blue graph at the middle of my screen. And that will tell us, here is what the gross amount of Social Security you can expect for the year. The reason why I find this incredibly important is because by the time you get that direct deposit into your checking account, that has already had either tax withholding taken from it, Medicare already taken out of it, and we won't really get a good snapshot of what your gross amount is that actually will be potentially included in your taxable income. So I really love getting an actual Social Security statement when we're doing our tax pro formas, so I know what's the gross amount, not just what's getting deposited into your checking account, or in this case, what might be deposited in your checking account as soon as Social Security starts. We'll go over Social Security in depth here once we take a look at the tax return in a moment or two. All right, so again, same strategy here that we had for our accumulators. We're going to put our current amount of taxable income into our software. We're then going to project out for the rest of the year, whether it's pension, Social Security, IRA contribution, distributions. We will calculate that. We'll load it into our tax software and we'll solve for what does things look like next April. So for our retirees, here's a copy of our 1040. Now you'll notice the first difference that we'll have from our accumulators is that there's not going to be anything here on line 1A in most situations, right? Line 1A is going to be blank because you are retired. You don't have W-2 wages. Now, some of you might be working in retirement. That's always a one-off situation, but we're going to speak to those that right here are solely living off of their investments, their pension, guaranteed sources of income, Social Security. All right, so the first thing we need to do is first calculate our taxable interest, our taxable dividends, line 2B and 3B, our interest, our dividends. Next up is our IRA distributions. So again, for this client, if you look at 4A, $19,403 of IRA distributions, but there's a different amount here on line 4B. Why would that be the case? Well, these three little letters here, if you see right above the word taxable amount, it says QCD. We'll talk about QCD here in a moment, but QCD stands for Qualified Charitable Distribution. This is for a client that does have a charitable heart that wants to provide to a 501c3 nonprofit, and they're also making required minimum distributions. So a special category of our clients, we'll talk about that here more in a second. This client's also receiving a fairly large pension. This is actually taken from one of our true cases. All of these are. This client was actually retired from the military. So has a really large military pension that's coming in. So we need to make sure to calculate that. And then we have our Social Security benefit. This client's receiving $61,000 in Social Security benefits. And you'll notice that Social Security benefits then slide over from line 6A to line 6B, and that's $52,000. Now, if you calculate and divide 52,000 into 61,000, you'll come up with a number pretty close to 85%. And that's the maximum amount that Social Security can be included in your taxable income. A lot has changed in the form of legislation, but one thing that has not changed is how Social Security is taxed. That did not change in the most current tax law that came out. It's taxed in the same exact way. And the way that it is taxed is first looking at lines 1Z, if there was anything, which there isn't, 2B, 3B, 4B, and 5B, and determining based upon those numbers how much of your gross Social Security can be included in your taxable income. And that ranges on a scale from 0% all the way up to 85%, depending on what those numbers look like. And there's a few thresholds in there. 50% is oftentimes a common threshold as well. We'll see about half of it in there, but it's a calculation that needs to be done. And this did not change as part of the latest tax legislature. It's taxed in the same exact way. What did change is a personal exemption. We'll talk about that here as we flip over to the next page. So for this client, first up, we're going to calculate what the total income is on line 9. That comes up to $182,656. We are then going to take a deduction from there, a standard deduction, $32,300. This changes also with time and legislature, so this number is not really important in today's conversation, but we are going to take a deduction from there. You'll notice with this client, we did take the standard deduction, by the way. So it goes back to the qualified charitable distribution. Matt, why did they fund the charity out of their required minimum distribution? And the reason why is because this client's not itemizing. So they get the benefits of funding their favorite charities, but doing so with their IRA dollars. It's really a very kind of cool concept for those that have a charitable intent and are not able to itemize. It's an excellent way to reduce taxable income down while still funding the charity. They were doing it out of their checking account prior to this. So now we're actually able to do it out of their IRA distributions. And it's a fantastic tool that we use pretty heavily here in our tax practice. Okay, so now we get our taxable income. Taxable income on line 15 is $150,000 once we take out their standard deduction. And now line 16, and really kind of bouncing all the way down to line 24, we see their tax bill. Their tax bill here in retirement is $22,548. So $22,548 is what's going to be due. Withheld, at least what we're going to estimate withholding there on lines 25D, is $17,292. So this client in retirement on fixed income is going to stroke about a $5,000 check to the IRS. Not something most of our retirees want to do down the road. But the great news, it's June. We have plenty of time to close that gap. And again, we have a number of ways we can do that. We can increase our withholding on Social Security. We can increase our withholding on the pension. We can make an adjustment on our IRA distribution withholding, or we can make an estimated payment. So we have a lot of tools in our tool belt to make this adjustment so that by the time we get to December 31st and ultimately then to April, we are not having this client living off of a fixed income to have to stroke a large check to the IRS. I know none of our clients love to do that, but this is how we go through that process. And this is how we figure this out. Now, we just got a question regarding modified adjusted gross income. And modified adjusted gross income is a really important concept, but mostly impacts our pre-retirees, those that are on the Affordable Care Act, or those that are applying for some sort of a benefit. If Mackenzie goes back to the previous screen, when we look at modified adjusted gross income, we are going to look at the gross Social Security benefits. So we don't care what happens on line 6B when we're looking at modified adjusted gross income. We're looking on line 6A. So that's the first thing we do now. The second thing is that we're looking at any tax-exempt interest. Tax-exempt interest is also an item that goes into modified adjusted gross income. So again, just to answer the question that just came through on our chat, is modified adjusted gross income really allows us to calculate the return using a different set of numbers and see if you apply for a benefit of some sort, or there's various reasons why we use modified adjusted gross income. And I think I know for this client who just mentioned that question, why he's asking that question, but it's using a different set of numbers. Again, using tax-exempt interest is being included in taxable income, and so is our gross Social Security benefit. Okay, so moving right along here, a client has about a $5,000 tax bill. What are we going to do about it? We have a number of different ways to solve this problem between now and the end of the year. Okay, so for our retirees, a couple things to think about. If you're in the age of 73 or older, you're making required minimum distributions, and you love to give to your favorite charity, talk to us about making qualified charitable distributions from your RMD. Again, great tool to use. There's a couple of very specific ways this needs to be done. So in order to follow in line with IRS tax code, we have to do it in a certain way. And again, talk to your advisor about, or the tax team here, about wanting to maybe give some qualified charitable distributions if you are having to make required minimum distributions. Next up, large expenses, right? We projected out your income for the year. We know how much is going to come out of your IRA, and you get a large one-off expense. That roof needs to be replaced on the house, or something crazy occurs. Maybe there's a big health issue, and we have to make that a large IRA distribution. Oftentimes, that's going to come from an account that we custody here at CanterPath. So what your advisor typically does is come to us and say, "Hey, I know you did tax pro forma. Client's gonna, we have it really well planned out, but now we need to make a $20,000 or $30,000 IRA distribution. How much should we withhold from that so we don't get into a tax rut down the road?" So we will make sure to have any large expenses at least addressed at the time those occur. And last but not least, here is legislative changes. I touched on it a little bit early in the presentation. Last month, we got a huge legislative change that's going to impact this year, 2025, mostly for our senior clients. Again, those that are 65 or older, making less than either $75,000 as an individual or $150,000 as a married couple, will receive an additional personal exemption. So this absolutely changes the tax plan around. When you're going to get a much larger deduction, we have less of a tax bill down the road. So again, we're able to use this as an adjustment. We were just notified about it, and the IRS hasn't even told us how all of these things are going to shake out. So certainly stay tuned for that down the road as we get a little more clarity. Once a bill gets passed by Congress, we then need the IRS to tell us how does it actually happen. And we have some bits and pieces on that and have already begun that process. But legislative changes always pop up. And again, we stay on top of those for the clients. All right, so to sum this up just a little bit here, we want to avoid that big tax bill. We can make quarterly estimated payments. We can make adjustments to our employer, our W-2, and make some changes there using tax form W-4, or we can adjust the withholding on our IRA. So we have a lot of tools in our tool belt just to make sure there's an actual plan in place for each one of our clients.
Okay. So now that we've covered some key topics regarding your tax planning, let's talk about what's next. If you're sitting at home thinking I should probably take a closer look at my tax picture, this is a great time to do it. If you have your phone, just take it out and scan the QR code on the screen to set up a tax review meeting with Matt. We'll walk through your numbers, take a look at your specific tax situation, and gather a few documents. From there, we'll build a personalized plan and share some recommendations to help you stay on track and feel more prepared going into next year's tax season. There's actually several strategies that can really improve your tax outcome, as Matt's mentioned throughout the webinar. But the key is planning ahead. So when you take the time to be proactive rather than reactive, you open the door to options that can help you feel more in control of your tax situation. With that being said, though, Matt, it does look like we have a few questions from the audience that I think that we should address. So the first one I'm reading is, I have restricted stock units. How do you calculate those in a pro forma?
Great question. And we get this a lot. And again, this is mostly for our accumulators. So, what is a restricted stock unit? A restricted stock unit is you getting paid, just not with dollars, not using dollars or direct deposit. It's you're actually getting paid with shares of stock of your company that you're working for. And the way that works is you typically have a grant date. That's the date that you get the stock award. And then you have a vesting date, and that's the date that you are actually able to physically get that stock. And that vesting date is the date that your taxes will actually be due on those restricted stock units. What makes the job really difficult is that most of the time, this is for companies that are mostly in the tech space. And if I said tech stock to the audience here right now, and I said, think about what a tech stock company's stock price is, you're going to say, Matt, they're all over the place. So what we have to do is predict in the future what will be the stock price on the date those shares vest. It's right up there with trying to figure out the pay cycle side of this equation. Not easy to do. But again, we've been doing this for a pretty long period of time. We're able to kind of come up with a range of where we think it's going to be. And we're able to kind of add that to our tax plan. And that situation where we might overshoot the number quite a bit, and there might be a big refund due to that, but it's certainly better than the other side of it owing a big amount. So RSUs are a really important part, especially for our accumulator clients and those that are specifically at a company that is generally publicly traded and oftentimes is in the tech space, although we do have some that are in various industries. But that certainly is problematic at times. But that's what we do. We figure out the problem and we go from there. So what we need to know is just what were those grants, when the vesting time period is, and then we can sort of figure out from there, if the stock is at this stock price on that vest date, here's what that taxable income is going to look like, and we'll take it from there.
Yeah, that was great. Okay, next question. Do we include your state taxes as part of your pro forma?
Oh, such a good question. Yes, we do. And I see some clients here. I'm looking at one client here on our list that is in the great state of Connecticut. So do we take a look at state tax? We absolutely do. In fact, 41 states have state tax. So just because we are here in Florida and we get to enjoy a wonderful tax-free state doesn't mean the rest of our clients are dealing with that. So absolutely. Now, here's the hard part. Again, I keep talking about the hard part. All of this is hard. If it was easy, everyone would do it. The hard part is there was 41 states that have state tax. That means there's 41 different tax codes, not to mention the 42nd one, which is the United States tax code. So each one of those states have their own different elements of what is included in taxable income, what's not included in taxable income. And again, we just have the ability to go to each one of those states, determine what is important to our client, what's going to impact them from a tax standpoint, and then we're able to do a tax pro forma on the state. The good news is that most of that income flows through from the federal into the state return. And so a lot of those calculations are able to be done through our software, but still there's so many intricacies with 41 different states and having to kind of figure out each one of those, what is important to that state and what is not important to that state. But most definitely we include that in each one of our tax pro formas.
Yeah, that was really great, Matt. All right, so we've covered topics in this. If we covered a topic in this webinar that you'd like to revisit, or if you know somebody that you'd like to share it with, take out your phone again. You can use the QR code on the screen and subscribe to our YouTube channel. We'll be posting the recording there in the coming days. And on top of that, you can explore all of our recent webinars on topics such as estate planning, the big, beautiful bill, and a lot more.
Well, you know what? You sat through 37 minutes here of me talking about tax pro formas. Kudos to you. We love doing these webinars. This is our 9th webinar of the year, and there are many more to come. We try to come up with topics that are timely, that are important. Some are investment related, some are economy related, some are based upon, I know we've had one on required minimum distribution. We have one coming up on the Affordable Care Act. What we love is being able to produce this content exclusively for our clients and then be able to kind of take maybe a complicated topic or something that is confusing and make it understandable. So we love feedback from each one of our clients. Of course, you have the ability to share this with family or friends or someone who's struggling. You have that friend who just keeps having a $10,000 tax bill and they're always annoyed about it. Share this with them. Maybe we can talk through how that can help them or what steps they can do to reduce these problems at some point down the road. But by myself, Mackenzie Herbert, the rest of the Candor Path team, thank you so much for spending some time with us. We look forward to our next webinar with you guys, and we are here for any questions, comments, or concerns. We love you guys. Have an amazing rest of your day.